Welcome to Rebank, your front row seat to the future of finance. Thomas Cowan, welcome to Rebank.
Thank you. Thanks for having me.
Great to connect. You're the head of tokenization at Galaxy. Effectively, I think of Galaxy as a crypto-native investment bank. Curious to know how you describe it. But maybe introduce yourself and tell us about your mandate.
Yeah, absolutely. So Galaxy is a crypto-focused merchant bank based here in New York City, IPO'd this year on the NASDAQ, and we are very much focused on all things on-chain. And so, our sales and trading side is exactly what it sounds like, just with all things crypto. Same with investment banking. We do M&A for crypto-focused companies, and our asset management arm is very much focused on getting investors exposure to all things crypto. I lead tokenization under the investment banking arm, and we chose to put tokenization there because we see the next wave of tokenization really being securitization. And so from that perspective, post stablecoins and tokenized money market funds, we really think that structuring and placement of different products kind of makes sense in that context.
Yeah. I'd love to hear you talk a little bit more about that, because I think maybe surface level head of tokenization, at least maybe 2 years ago, the concept would be we don't have any tokenized assets. We think that some assets might be tokenized. This is kind of some combination of a technology problem to solve plus some sort of asset structuring or fund structuring. But it's really about how do we take a traditional investment structure and make it kind of compliant in a tokenized way. But I think we moved well beyond that. To your point, it's almost like what the securitization desk might be in a traditional firm. I imagine you're thinking a lot more now about structured products potentially that aren't possible or easy to create in a TradFi sense, but which might be possible now in a tokenized environment. I wonder if you could talk a little bit about that, and maybe even how your role has transitioned or evolved over the past couple of years since you've been in the seat.
Yeah, totally. I think in previous cycles, we've seen tokenization being really focused on the technology itself, where the focus was just on taking these assets, putting them in an SPV or some other structure, and then tokenizing that structure and issuing tokens against it. And while that was an initial strong first step to demonstrate what's possible, in this cycle, we've really seen a transformative shift happen where it's not just the tokenization, but much more importantly, to your point, what that unlocks and how that is materially different. And we see kind of three key trends that have unlocked that and really pushed things forward in this cycle versus previous ones. And that's the technological maturity of the different blockchains, and the smart contracts themselves are materially different than the previous cycle. The regulatory clarity that we've really seen really allow institutions to come in at scale. And then finally have those large TradFi players not just be, on the edges looking in, but really jumping in and allocating capital, time, and resources towards this technology. And so what's happened is those three things have come together to create a headwind here, so that we not only are just focusing on the technology, but much more importantly, additional use cases. And you can really dig in and think through what that enables. And for us, when we think of, putting a structured product on chain, quite often TradFi will say, hey, the system works relatively well today, especially in the US. Why do you need a blockchain? What does this actually unlock? From our perspective, we really see four key benefits for that. First is you end up with instant settlement. So you can think of a typical CLO structure where there might be a portfolio of underlying loans. If all those loans are on chain to start with, it means that they instantly settle, and you can just see all of that unfold in real time. And it's much more efficient than today's system that might have dozens of banks that are all serving all these different loans. So that's the first thing, is it's just much more efficient from a cost perspective. The second thing is you end up with full transparency. So that means you can just see the performance of all the underlying loans in real time, which is transformative compared to today's system, where quite often you end up with a 2-page PDF that you get every quarter, every month, saying, hey, here's the performance. In this case, you just see it all in real time. And then the third bucket we really see is, because of that transparency, you end up with a much more efficient secondary market, because you can really see what's happening, and it allows people to have much higher trust in the underlying asset. So it's a much more likely to be purchased and move between different stakeholders. And then fourth and finally, because that we have that secondary market and we have that transparency, it means that people are much more likely to accept it as collateral and allow you to lend against it at a much higher rate, because there's that transparency. And so really what it does, those four benefits of instant settlement, transparency, secondary market, and collateral, means that it really does transform the back end of these different structured products when you put them on chain.
Are you responding to client demand? How does a new tokenized product come to market? Something you're working on. Is there some sort of internal push that says, hey, let's prove out more value here. Let's show the market why tokenization matters. Is it inbound from a client, people saying, hey, I read all this stuff about tokenization, maybe I should do it too? Or I don't know, are we maybe even more evolved from there, and it's a specific investment strategy which can kind of maybe only exist via tokenization, or a problem that you can solve for your own balance sheet or for your own distribution, or whatever it is in tokenized form?
Yeah, so we've really seen it happen in two phases. The first has been Galaxy itself as a business and what the demand internally looks like. And for us, we're seeing crypto native products where the cost of capital is quite high on chain, where we can think through different structures that enable us to syndicate out some of those loans and allow us to lower the cost of capital. So that's one aspect of it. The other is beyond crypto native products to more TradFi institutions looking to get on chain. And that shift is something that we expect and we really will see over the next year or so as we partner with, the largest traditional financial players to begin this process. And we're just going to start there, where it's definitely it's going to be a long road here, but you got to start somewhere. And we know that multiple years from now, most of this will end up on chain, but it's going to be a long road.
Yeah. How do you see that road unfolding? Is it specific asset classes come first or come later? Is it like building products for different pools of capital or cohorts of investors? How do you see it playing out?
Yeah, so I think when I think about like kind of where the market is and where we are in the adoption curve, I kind of put it into four main categories: stablecoins, money market funds, debt, and equity. And so we've already seen with stablecoins clear product market fit in three specific use cases: more efficient cross-border payments, overseas dollar access in emerging economies where people want to access the dollar and get out of their local currency. And then still the biggest use case today as a trading pair for people to be able to access Bitcoin, Ethereum, and other digitally native assets. So we see that product market fit with stablecoin specifically is really taken off. I think around 300 billion in terms of overall size. And so that story is very much present, and we'll see strong growth there continuing. Over the past year and a half or so, we've seen tokenized money market funds really begin to take off and show demand on chain, which makes sense. Once you can move money more efficiently using stables, you're going to want to store value more efficiently, and it makes sense to have that risk free rate on chain. And I think Biddle, Benji, and a few of the other large players have demonstrated that utility to the market. And 2025 has really been about, okay, what's next? Given those two, kind of where's the market going to go to? And when it started, I actually didn't think that tokenized equities would make as much progress as they have. It really did take off, and it's a testament to many of the key players in the space who really pushed the envelope and said the time is now to tokenize equities. And we really saw a few different companies all taking different structures to get equity representations on chain. And Galaxy actually recently tokenized our stock with Superstate in September. So we were excited about that. And then there's the on-chain debt, which I kind of already touched on, but I think because the inefficiency is so much greater and the secondary market is substantially inefficient off-chain, I think there's just a lot of efficiency gains to be had once you put things on chain. So I know that's a lot, but I really see over the next 3 or 4 years, that's kind of the adoption curve that we kind of see, and we're preparing the business for over the long term to make sure that we're the most positioned that we can be.
So there are many different parts of Galaxy's business, as you described, where the market has been choppy.
I think really when we look at the markets today, or when I do, obviously speaking for myself, 2025 has been such a tremendous year for the industry. There have been so many wins and so much progress that I think in many ways the market is just kind of taking a step back and thinking, okay, what is the new narrative? Where's the next step higher? Because we've made so much progress that in many ways the question is what's the next step? And could that be the Clarity Act? Could that be kind of, rates lowering even further to be able to enable more risk on capital? There are definitely some unlocks and opportunities that could happen. But right now it really seems like, okay, given October 10th and a few other examples where the technology maybe hasn't shown that it's fully there quite yet, I think it's kind of an opportunity for the market to step back and say, okay, we've seen ups and downs in previous cycles, and the question is what we think will actually happen over the next year or two. That, and of course, the fact that it's been a long road since the having of the last cycle, and so the question is what that looks like. So there are a lot of different indicators that you have to weigh in both directions, and I think we'll really see what happens over the next couple of weeks. Will really be indicative of the next 6 months to a year.
And I guess tying that back to your day to day, I mean, I think a lot of the conversations that you're having are with large incumbent financial firms, TradFi companies who are really looking at the space. And I think to your point about progress in 2025 have really changed their outlook completely when it comes to what the role of digital assets or tokenization is for their businesses. Is there any relationship between the broader, I guess, crypto market fear and pain that we've experienced recently and the tenor of the conversations that you're having with large enterprises? I mean, if you think back to 2022, basically FTX happened and it scared off all the TradFi firms. Like everyone who was starting to explore the space basically ran away. And actually, I mean, I feel personally for a lot of these people in head of digital assets roles at these firms who were kind of just starting to build some momentum internally for what they could do, and suddenly, these sort of offshore scammers collapse the whole market, and now these guys are in a tough position where they're having difficulty maintaining or building political capital with their colleagues. It feels like there's more of a decoupling at this point between the institutional activity in digital asset space, tokenization space, and kind of the speculative casino of crypto. But I'd be interested in what you make of it from where you sit.
Yeah, spot on. I feel like for those of us who've been in this space for multiple cycles, whenever the price of Bitcoin skyrockets up, you see traditional financial players begin to build out their digital asset teams and really invest. And then during the next downturn, a lot of the time those teams kind of dwindle and kind of wait for the next cycle. And I think in this one, because of those 3 points I referenced earlier, where we have regulatory clarity, we have technological maturity, and we just have institutional demand that is so much greater than we've seen in previous cycles, it does feel as if there is a bit of a decoupling, to your point, between the crypto native assets and the price of crypto specifically, and tokenization more broadly. Because the narrative that we really, or at least I really work to broadcast, is to separate tokenization from crypto, and really just showing the tokenization, the nature of the technology, can just move and store financial assets in a more efficient manner than the system that we use today. And so that's separate from the price of a digitally native asset, and that's really what we're pushing. And the other thing I'd note as well is the nature of the conversations really have changed over the past maybe 6 months or so compared to a few years ago. I think very often I'd be the one reaching out to a lot of these main players saying, "Hey, this technology is really revolutionary. It's something that you should begin to think about." And now they're reaching out to us saying, "We really need to get into the game. What can we do to make sure that we're on the forefront, that we're investing where we should be to really leverage the technology to upgrade our existing system?" And at the end of the day, that's really going to be the first wave of adoption here, is not to upend the financial system, but to upgrade it. And that's really the mindset that we're increasingly seeing. And that's separate from the price of Bitcoin. Though I will say it's always helpful when we're up and to the right.
Yeah. I mean, I ask myself, like, what is the thing that could kind of explode, break, definitively end this cycle in crypto, send us back into crypto winter? And what would the implication be, the impact be for the TradFi adoption that we've seen? I guess the nature of these things is it's always very hard to predict what the weak link is until it's obvious in hindsight. But I don't know, maybe I'm cautiously optimistic that whatever breaks in crypto won't impact the TradFi energy as much as maybe it has in previous cycles, but let's see.
Yeah, I think predictions are always hard to make, especially in crypto, and especially in this cycle where so much of it is politically and regulatorily dependent. I mean, putting those three things together, it's anyone's guess. But
Yeah.
what's important is this industry is always takes two steps forward and at times one step back, and this really does feel like we're at a precipice in terms of what's really possible here, and we're excited to continue to push forward.
Yeah. I guess maybe, if it's some sort of crypto asset deleveraging, probably that's not as impactful for an incumbent financial firm who's starting to build in this space. I think if there's some sort of mainstream stablecoin issue, some sort of blow up at a large stablecoin issuer, some sort of legal, regulatory, basically the firms that have been waving the flag and kind of leading this institutional adoption. I think if there's some sort of issue there, that's probably the biggest existential risk, right?
That would be a big problem, especially because from compared to the previous cycle, that was really, had a few major failures. Terra Luna was one, of course, FTX was another. And for the past few years, a lot of the leading blue chips players in crypto have really worked hard, rightly so, to demonstrate to the market, to regulators, and to counterparties the fact that they are responsible players and that they recognize the fact that you need to put in place guardrails and have key risk metrics and risk teams to make sure that we're as responsible as possible. And so to make sure that trend continues is really key for adoption, not only in the short term but also the longer term. As much of these large players, they don't think in years, they think in 5 years, 10 years. And so those allocations and those decisions that are made at senior levels really do take in sentiment of the market and the past few years and where they see it going. So it's important that people kind of move a little bit more slowly than those of us in crypto want to, but just to make sure that we're crossing our T's and dotting our I's at every point we can.
A couple other observations I'd love to run by you just in terms of what we've seen over the past maybe 3 to 6 months. It felt to me like a lot of the kind of tokenization initiatives, maybe 6 months ago, incumbent firms or asset managers looking at creating and distributing tokenized products, they were kind of looking at what BlackRock had done with Biddle, and they were viewing on-chain capital as kind of this new pool of potential AUM that they could tap into. Like, hey, if we can get a product to market, then we can get some of this crypto money into our products also. We've moved on from there. I don't feel like, well, firstly, I think it was a relatively naive view, perhaps. I think it's also clear at this point that really there's only a few $1 billion worth of this theoretical on chain capital looking for a home in a tokenized TradFi product. So therefore, that idea of like the fifth, the eighth, the 10th issuer coming to market with like another money market fund, or even a slightly different flavor, and and they're getting an allocation, which at the end of the day, I mean, like 80-90% of what we're talking about is ultimately coming out of the Sky, formerly Maker ecosystem. It's like
Yep.
2 or 3 allocators. You're talking to these firms, you're building these products, you're thinking about distribution. What's the thinking now? Where is the capital that's going to be coming into these products? Is it more on-chain capital, or is it looking for kind of the natural nexus between new product structures and easier on ramps, maybe for TradFi for some of these firms onto upgraded settlement rails?
Yeah, it is funny that at the end of the day, that crypto ecosystem is still pretty small, right? It's 3 or 4 trillion total, and the vast majority of that is Bitcoin and Ethereum. And when you look at RWAs, to your point, it does end up being a few billion. So the question is, kind of today, that's where the beachhead is. And so short term, that's kind of the focus of set of players that you're selling into. But I think with the longer term mindset is really the approach that you need to have with this market in terms of, yes, today that's where we are, but long term, these products need to be built not just for crypto natives, but much more importantly for the much bigger TAM of TradFi more broadly. And I think money market funds are a good example where if you look at the fees that many in the market charge today on chain, they are substantially more expensive than an off-chain money market fund, right? So if you're banked and you're a large institution and you have access to both products, it would be a hard decision to make to choose to go for the on-chain product over the off-chain product. That being said, there are key pain points where that really does make sense, and where we're going to see larger adoption in the next wave. And a good example of that is for overseas access and for movements outside of normal banking hours on the weekend, for example, is something that is a big pain point for a lot of capital allocators and for a lot of institutions that really do have capital needs 24/7, but can only move the capital that they need during banking hours. And so that is one thing that people in the space are very much focused on and zeroing in on, saying, look, we know that's a pain point. We know we can design these products to solve that. The question is when that kind of reaches the point where it'll begin to take off. And I think 2026 is likely the year for that, where people will begin to see use cases beyond, to your point, just that initial few billion allocation from Sky and a few other players. But we'll see. I mean, that's the demand is definitely real, and the question is, at what point will we begin to see the vertical part of the S curve?
I mean, it seems to me like it's ultimately going to come from, it's like follow the stable coins basically. A year ago, stablecoin activity was like basically purely on chain
Yeah,
trading, still a lion's share, but there's an increasing amount of real economy, economic activity. Cross border payments, treasury management is a natural kind of next use case. And I think as you start to diversify, like basically that capital, I think will ultimately find its way into some of these tokenized products, which the likes of you and our peers are creating and issuing, which kind of take it over and above just allocating into or at least issuing these products into this kind of finite pool of crypto native capital. Let's see.
yeah. I mean, I hope we're both right, and that a year from now things look materially different. But we've been here before, so I'm not going to hold my breath.
All right. So the other observation, again, if we rewind maybe 6 months, money market funds were kind of where the majority of the market was focused. I guess there was maybe some notable tokenized private credit type products as well. More recently, there's been a lot of excitement around CLOs. Uh, I mean, even the words excitement and CLO together in the same sentence
This is when we realize we live in a very
seems a little
niche.
bit foolish. But hey, this is
Yeah.
this is institutional finance we're talking about. What do you make of this? I mean, why the sort of transition from this focus on tokenized money market funds to different types of similar liquidity profile, I guess, slightly higher yield type products?
I think really what it comes down to is if you look at where product market fit has been for the products that have really taken off, stablecoins, much more efficient way to move things, money market funds, more efficient way to store value and get access to the risk free rate. And when you think of CLOs or other structured products, the off chain, structures today are just comparatively inefficient, right? The settlement time is expensive. The servicing costs are high. The secondary market is quite challenged. And from a lending perspective, it's also challenging. And so when you look at what blockchain technology is capable of doing, that market is ripe to be transformed simply because it can really take a lot of that inefficiency and mitigate it. And so will it take a long time to get there? Absolutely. But one of the things that has really helped move the industry forward is whenever you have a story where you can say, here's the old system and here's how it works. Here's the new system and here's how it works, and compare them. And in this case, I think when you look at structured debt products, we're getting to the point where, from a sophistication point of view and from a on-chain structure point of view, we're pretty close to being able to have those two comparisons and be able to say, hey, this really is faster, better, cheaper, and the risk profile now that the technology has matured to the point where it is almost equal to that of the traditional system means that traditional institutions are going to look at that and say, wow, this is materially better. And you can kind of separate it from the risk on parts of crypto and simply look at it as a more efficient back end to move and store value. And so we,
Mm.
in the long term, look at this technological decision to put different structures on chain, increasingly think about how the tech part of a business might think, oh, do you use, Azure or do you use AWS? It's one of those things of like, the rest of the business shouldn't really have to allocate time or thought to it. It's just something that the tech side thinks about. And that's really where we see tokenization ending up in the long run is 5 years from now, 10 years from now. I hope I'm not talking about tokenized debt I hope I'm just talking about debt, because the back end, everything will be tokenized, and it really will just be a more efficient way to move and store capital going forward.
Hmm. Yeah. Now, interesting that kind of efficiency lens around some of the CLO momentum. I hadn't I hadn't really picked up on that. I mean, I saw the Anemoy Janus Henderson JAAA product, which they announced and launched maybe this summer with a sizable allocation from Grove, I think. And
Hmm.
then just recently, Securitize and BNY announcing a tokenized AAA CLO, which I guess simplistically for me, it had just kind of been, well, hey, this is a high quality, investment grade product, which instead of yielding 4% yields 6%. Eat it
I
up,
mean, it's
market,
yeah.
But actually, it sounds like there might be, at least in your mind, more to it than that. Some of what you were saying actually reminds me of a conversation we had a few months back with Kevin Meow, who built Block Tower Credit, and effectively I think in partnership with Centrifuge years ago. At this point, kind of built a lot of this securitization stack on chain, fully automated. It does feel like ultimately that's the north star for a lot of at least securitized or structured debt type products.
Yeah, totally. And I think that the key there is, it's always exciting when large companies like that do make the decision to tokenize and go on chain. One thing to think through is what the underlying structure really is. And a lot of the time up until now have been very much private funds and tokenizing of different funds specifically, where it's, a wrapper or an SPV that you're issuing tokens against. And that's a wonderful first step. And really what I think the next step is going to be, where we're likely going to see quite soon, to your point with Kevin, and Block Tower, is how do you make sure the waterfalls themselves, the underlying loans, and the entire facility is fully on chain. So you no longer have that SPV and the tokenization of an existing structure, but the structure itself lives natively on chain. And that shift is not going to happen overnight. It's a big jump, but once we can demonstrate the first couple where it truly is faster, better, cheaper, then we can again show, hey, this happens to be a more efficient way to do this, and so we're excited to see that progress happen, and I think we'll really see that unlock happen in the next 3 to 6 months. And the question is, once that's demonstrated out into the market, how quickly the rest of the market catches up, sees it, and runs with it. And it's, in some ways it moves really slowly, and in other ways, when there is a lot of opportunity, people can move pretty quickly. So I'm opportunistic to see how quickly this will move once we have the couple of examples that really demonstrate the difference between the tokenization of a private fund or an SPV versus having a fully on-chain structure from end to end.
Mentioned Galaxy having worked with Superstate to tokenize your Nasdaq listed stock. Was that exciting internally? Were people enthusiastic about that? Are you and your colleagues paying for coffees from your MetaMask with Galaxy stock, or
I wish.
settling side bets or something?
I
It's a
wish that were the
trading
case.
floor after all, right?
Exactly. I wish that were the case. One thing I will say is, my job is to tokenize things. So, of course, I've wanted to tokenize our stock for a long time. We really wanted to make sure that when we chose to do so, that we did so in a way that would not only make sense for Galaxy and our shareholders, but more importantly, for the market more broadly. So we could use it as an example, not only to the rest of the market, but also to regulators as well, to say, hey, this is the tech stack that we think makes sense for broader scale. And so through a partnership with Superstate, which, full disclosure, is a portfolio company of ours, we were able to work with them as an on-chain TA for us to tokenize our stock and have the token itself be the equity. So, on my Phantom wallet on my phone right now, the tokens that I hold are Galaxy Class A common shares. So they don't represent ownership of an SPV. They are directly Galaxy shares. And, to everyone else, that may seem like a small little difference, but to us crypto nerds who think about this all day, every day, it's a big deal, because it really means that we've created the efficiency and the structure that we think works not just today, but more importantly for the longer term. It's very much, you can tokenize it and you can transfer it if you're both whitelisted through Superstate. But we think going forward, and we hope so soon, to enable it to be traded more broadly through in a permissioned and KYC environment. But that's definitely something that we have not done yet, but we're exploring, and when the market is ready and regulators are ready, we really do want to charge ahead.
Makes sense. Maybe on that point, like it's just a perfect representation, I think, of where Galaxy is and how you guys are positioned to basically bridge traditional financial markets and crypto markets. I think, in a sense, bring a lot of like cross fertilization in both directions. Um, your DNA seems to me to really broadly cover both worlds. How do you guys think about the biggest opportunities? Where Galaxy can kind of leverage your strengths over the next 1, 2, 3 years.
Yeah, I think you really nailed it in that this firm is has the DNA of TradFi, and a lot of us grew up in the traditional system, but has the expertise and the interest in crypto. And so it means that as these two worlds continue to come together, Galaxy is increasingly at ground zero to help make these two worlds, kind of merge. And so in terms of opportunities that I see at Galaxy and tokenization specifically is continuing to bring both groups together. And I think the number one thing that really it boils down to is education and making sure that, you can explain the complex craziness that is crypto to a traditional financial audience and vice versa, and explain, why the system is set up the way that it is, the benefits of it to a more tech savvy, blockchain focused audience. And for too long, those two have been in parallel worlds in previous cycles. And in this one, we're beginning to see that blend happen more and more. And Galaxy is fortunate to be positioned to not only understand the tech really well, but also the financial side well. And so it'll continue to be a long journey, but in many ways, it represents, 8 years ago when Galaxy was founded at this intersection, that we're finally at the point where the two worlds are coming together. And we're really looking forward for 2026 and beyond.
Yeah, amazing. Thomas, thanks so much for making time for this conversation. Really valuable to kind of get inside the way you guys think and operate and how you're seeing the immediate opportunities here.
Of course. Thanks again, Will.
Thomas Cowan, thank you very much for joining us today.